I think that the Fed yesterday emphasized that the baseline remained positive. So it's not at all clear to me that the outlook has changed in the base case. I think the issue is that the downside risks are judged to be much higher right now. And I think that for the US, many of the downside risks are coming from overseas. China slowed down, weaker data in Europe. You saw the IMF mark down its forecasts for Europe recently, and then of course trade issues and the like that are creating uncertainties.
Can I just be pedantic for a moment? I mean, the phrase further gradual increases was dropped, which to me does look like a material shift in how the Fed is positioning sentiment. Would you not agree?
No, I absolutely agree with that. Again, I think they said that the baseline was positive, but the downside risks were higher. They're going to put interest rates on hold, and they dropped their tightening bias. You're absolutely right. And then I think to further reinforce that, there were some changes in signals on balance sheet normalization. So I think when you put it all together, I think it is a significantly different picture from the Fed, notwithstanding that the baseline may continue to be good and positive.
So what spooked the Fed? Because one view is that central banks do actually move when there's significant events unfolding across economies, and we saw at the late end of last year that the market was spooked. Extreme volatility in the stock market, cratering on major indices and stocks at the same time as a trade war was playing out between two major economies. Do you think that's enough to spook a Fed?
I think that some of the downside risks that I mentioned are key. I think the financial market volatility you allude to reinforce that picture, but again, I do think that what is happening in China raises some question marks, and then the further dampening effects of the trade uncertainties feeding through to economies overseas and perhaps the United States. So I think it's just putting that all together. That is what is driving the Fed. I wouldn't necessarily use the term spook, but perhaps I'm not as colorful as you. But I think those are what is changing the Fed's outlook.
Is this the most dysfunctional? And you have, a lot of. You were Deputy Assistant Secretary at the IMF as well. You've looked at all these as well. You've had a whole host of very important positions in that. Obviously, still at OMFIF as well. Is this the most dysfunctional government in the United States you've ever seen? I.e., you've got a president who adds fiscal stimulus at a time when conditions are good anyway, and a president who creates a shutdown situation which has taken percentage points off the GDP growth at a time when there's a slowdown as well. It seems disastrous economic policy to me.
I have been one who's criticized the policy mix in the United States. I agree with you that at a time when we're later in the cycle and we are performing quite well, that is not the time to add substantial stimulus or increase in the deficit. So I think where we're going to end up is a deficit heading towards 5% of GDP, which is extraordinarily high. I think this is increasing the supply of paper on the markets, and I think at a time when the Fed had been raising rates or beginning to bring them back towards normal, it's putting substantial pressure on financial markets, and I think this is the wrong policy mix for America.
Hi, I'm Joanna Bersecci, and thank you for watching. You can check out more of our videos by clicking on the boxes on the screen. And don't forget to subscribe to our channel for more from CNBC International. Thank you for watching.